If you have been watching the semiconductor industry for the last few years, you know the story of Intel has been one of pain. We have seen lost market share, delayed technology nodes, and a stock price that seemed to find a new bottom every quarter. But if we look at the financial documents from late 2024, and specifically the critical third quarter of 2025, the narrative is shifting. We are no longer just looking at a struggling giant. We are looking at a company that has undergone radical surgery to survive and is now rebuilding its foundation. Today, we are going to dive deep into the 10Q filings from 2025. We will deconstruct the headline numbers, analyze the true impact of the Altera divestiture, and explain why the U.S. government's massive intervention in Q3 2025 changes the entire investment thesis for Intel. We aren't just looking at chips. We are looking at the restructuring of American industrial power. To understand the present, we must briefly look at the valley of death Intel crossed in 2023 and 2024. The annual reports from those years show a company bleeding cash, investing billions into new fabrication plants or fabs, while its revenue from data centers was under attack by competitors. The strategy was IDM 2.0, building chips for themselves and for others. It was an expensive, risky bet. By mid-2025, the market was questioning if Intel could even remain solvent without cutting its massive capital expenditures. Then came the third quarter of 2025. The report filed in November 2025 contains data that is absolutely critical for any long-term investor. The headline number was a shocker net income of $4.1 billion. Compare that to the catastrophic $16.6 billion loss in the same quarter of 2024. On the surface, it looks like a miracle recovery. But as smart investors, we need to read the footnotes. This profit wasn't largely from selling more processors. It was financial engineering and strategic selling. The 2025 Q3 report reveals that Intel completed the divestiture of Altera, its programmable solutions business, on September 12, 2025. They sold a 51% controlling interest for about $4.3 billion in cash. This sale triggered a massive one-time pre-tax gain of $5.5 billion on paper. So while the profit looks good, it is a result of selling the family silver to pay the mortgage. However, this was a necessary move. It provided the immediate liquidity needed to keep the factories running without drowning in debt. But the most significant event in Q3 2025 wasn't the Altera sale. It was the U.S. government agreement. The documents detail a transaction that is historic. On August 27, 2025, Intel received $5.7 billion in accelerated disbursements from the CHIPS Act. In exchange, they essentially made the U.S. government a major stakeholder. They issued 275 million shares of common stock to the Department of Commerce and a warrant for another 241 million shares. This is dilution, yes. Existing shareholders own a smaller piece of the pie. But in exchange, Intel secured a fortress balance sheet. The fear of bankruptcy is effectively off the table. The government has signaled that Intel is too big to fail. Now, let's look at the core business operations. Starting with the Client Computing Group, or CCG, this is the division that makes chips for laptops and desktops. Revenue in Q3 2025 was $8.5 billion, up from $8.2 billion the previous year. This indicates that the AI PC cycle is real. Consumers and enterprises are starting to upgrade their aging machines to newer laptops, capable of running local AI models. However, operating income in this segment actually dipped slightly to $2.7 billion. Why? The report cites higher unit costs from ramping up newer, more complex products. This is the cost of innovation. They are selling better chips, but they are expensive to make until the manufacturing process matures. The Data Center and AI Group, or DCAI, shows a stabilization story. Revenue was flat at $4.1 billion. While they aren't seeing the explosive exponential growth of NVIDIA, they have stopped the bleeding. The most encouraging metric here is operating income, which more than doubled from $381 million in 2024 to $964 million in 2025. This shows that the brutal cost-cutting measures the layoffs and efficiency programs detailed in the 2024 10K are working. They are doing more with less. They aren't just chasing market share at any cost anymore. They are focused on profitable niches. Finally, we must address Intel Foundry. This is the future of the company. In 2024, this segment reported staggering operating losses. In Q3 2025, the picture improved, but it is still difficult. The operating loss narrowed to $2.3 billion, a significant improvement from the $5.8 billion loss a year prior. Revenue for Foundry is still mostly internal, meaning they are building chips for Intel, but the reduced losses prove that the separation of the Foundry business is driving efficiency. They are learning to act like a real contract manufacturer, tightening their belts and optimizing yields. So what is the outlook for 2026 and beyond? Intel has effectively reset its business. The smart capital strategy mentioned in the 2025 reports, combined with the government partnership, means they have the runway to finish their 5 nodes in 4 years roadmap. The critical 18A process node is the end game. If 18A succeeds, Intel becomes the most advanced manufacturer in the world, surpassing TSMC in performance per watt. The risks are still massive. Execution is everything. But the Q3 2025 report confirms that the financial crisis is over. They have the cash, they have the government backing, and they have a stabilizing core business. For a value investor, this is no longer a falling knife. It is a reconstruction project with a government-backed floor.